Good afternoon, ladies and gentlemen. My name is Charles Perron-Pichet. I'm here with my colleagues William Lee, Dividend Sharma, and Tim Zhao. We are men in Black Scholes, and the company we're presenting today is General Electric. We have a short recommendation, $12 target price, which represents 21% downside versus where the stock closed at $15.25 on Wednesday. So, a quick overview of the company. General Electric is a globally diversified conglomerate with exposure to power, aerospace, healthcare, renewable oil and gas, transportation, and finance. It was founded in 1892. It has 185 manufacturing plants in the US and 325 others globally, headquartered in Boston. The market cap is about $130 billion in market cap. And as you see on the right side at the bottom, the power and aviation segment represent more than 50% of the company's revenue. And if you look at the financial performance, hasn't been that great for GE over the last few years. The revenue kind of stagnated, and while the EBIT margin came down from 11.6% in 2014 to about 8.3% in 2017. Just a bit digging a little bit deeper on the revenue and the division. So they have 7 big markets, if you want. I present here the 2017 revenues as a percentage of total, the 2017 EBIT, description of the division, the industry outlook, and the company's outlook for these divisions. And as you see on the left side, the company mentioned that they see their future with 4 key divisions: power, aviation, healthcare, and renewables. As you see at the bottom, the industry outlook for these industries are quite good in general. They're driven by many strong fundamentals across the board. And as you see for healthcare and aviation, the company is quite bullish on its outlook, especially in jet engine side and the healthcare side as well. However, for power and renewables, it's not as good because the company has some issue with some of the products that they have, and they're also losing market share in certain sectors, especially in renewable. And so the outlook is not that great for GE in those specific markets. Meanwhile, they also have an oil and gas division, BHGE, for Baker Hughes, GE, Capital, and others. And as you see, the outlook in those divisions is not as great, and the company might divest this division going forward. 2017 was a tough year for General Electric. Share price dropped 45%, while year-to-date, the stock is again down another 13%. This was mainly due to a series of underperformance, quarterly results versus consensus. Also, the company changed CEO on June 12, 2017. Mr. Jeff Immelt, that had been there for, I think, about a decade or more, that finally retired, and it was replaced by John Flannery. The company on October 20th reported unacceptable results, according to the new CEO, and since had an investor day on November 13 and cut the dividend in half and unveiled a soft 2018 guidance that they since have revised downward again. So it's not looking great, or it wasn't as good for GE over the last few years, as you can see.
So the key question here is, can this ship be turned around? And GE for sure has come up with a restructuring plan. And as you can see, there are 3 big chunks to the plan. The first one regards their portfolio, and they want to keep power, healthcare, and aviation, their biggest segments, and want to get rid of the other ones in due course of time. They see a potential $20 billion plus asset sale in the next 2 years. A few things about capital allocation. They want to have more discipline regarding M&A and dividends, want to improve their cash flow generation, which incidentally is way behind their peers. And on the people front, they want to improve their culture, reduce the count of directors, have compensation being linked to performance, and so on and so forth. So all right noises here, but what remains to be seen are the exact specifics of the plan. The street would obviously love to see timelines and exact specifics of how they're going to go about this. So as far as we see it, it seems more optimism than reality at this point of time. Maybe in 2 years or 3 years, GE surprises us. But for now, there's optimism and very little to back that optimism. So let me jump into our first investment thesis for GE. And this concerns the health of the various segments that GE plays in. As you can see, power, aviation, and healthcare are the 3 biggest chunks. And there are headwinds surrounding power from multiple sides. One, there's a lot of overcapacity in the system, and that's what everybody in the industry is talking about, including their peers. A secular trend towards renewables is certainly not helping GE, Siemens, and the like. People throughout the world, governments are shifting from gas and coal towards solar and wind. As a result of these, we do not have much optimism surrounding GE's numbers for the next year. In fact, if you look at some specifics regarding GE itself, they've had concerns with their class gas turbines, which is their premium, their lead product. And these concerns have resulted in a few orders being lost. They lost an order recently in Pakistan. There's been another auction in Brazil where they lost. So there's a lot of reason for pessimism. Maybe GE can turn it around in a few quarters, but we are not very optimistic, because of which our estimates are 20% below that of the street for this segment. Aviation and healthcare are arguably their strong suits. Pretty strong market dynamics there, and GE is a strong player. So we pretty much agree that GE might do well in aviation and healthcare. Oil and gas, mixed signals there, some positives and negatives, but a lot of story behind the synergy realization is yet to be seen with Baker Hughes and the GE legacy. Again, no reason to believe that GE will be able to outpace and do much better than what they've done before. Here our EBITDA estimates differ from the street. Again, we are taking this at almost zero growth versus the 2017 fiscal. Renewables, arguably a sector which is going to grow throughout the world, but GE is not the player that you would want to bet in renewable space. Renewables is a very price-sensitive segment, and their competitors, both European and Asian, are giving them a tough challenge in US as well as outside the US. GE is losing share. It had a 40% share in 2016, dropped down to 29% in 2017. So that gives you a picture of how things are for GE in this segment as well.
So let's talk about the second point I want to highlight, and what people are bullish on GE talk about these days is the potential for asset sale and the creation of value for shareholder coming from these assets. So the company talked about 20 billion of asset sales to restructure the company. The most common segments obviously are the transportation, lighting, and also oil and gas. And so, as you see here, the problem that we see is that we believe the street in general, or people are optimistic on this, underestimate the complexity and overestimate the value generated from these transactions, given the significant pension deficit and leverage that GE has as of today. Just more detail on this, GE has the largest pension deficit among the S&P 500 companies, with 31.1 as of 4Q17. The net debt to EBITDA ratio is also quite high at 5.4 times as of 3Q17. And so how do you split this element when profitability and headcount vary significantly by division? It has to be discussions, and we believe that this definitely make the transaction a lot more complicated. And we believe that either the timing of those transactions or the value that they will generate is at risk at this point. We have some stories. If you look just last year, Bombardier, another large industrial company, conglomerate, has a similar situation where they wanted to sell some of their core industrial asset. And unfortunately for them, they were only able to monetize a 51% stake of their C-Series program, which is the best value asset of the company, and they got it for zero equity. Zero equity. So our view is that it's pretty hard to monetize these types of assets at the value you want, given the complexity of these companies and the structure and their employee headcount and pension deficit. And so we believe that the other thing that could happen is actually they spin off only a minority portion of these assets, but it doesn't solve the problem that the company structure is way too complex, and also that that will probably not generate the same expected value. So it's important to note also how much value they could generate if they were able to sell some of those divisions. So we talk about transport, we talk about lighting, we talk about oil and gas. As you see, we use an EV to EBITDA multiple approach on these assets, and as you see on the top left, EV EBITDA multiple, I think our multiples are quite high, 12 times for transportation, 10 times for lighting, 11 times for oil and gas, if they were able to sell these divisions, giving us a gross value MBS for our name of our team and the consensus. And as you see, it varies between about $680 million for lighting to about $18 billion for oil and gas. However, afterwards, you need to probably get some pension deficit in that and also some debt in that. And so we prorated the pension deficit as a percentage of total employee, the pro rata of total employee in this division, and the industrial EBITDA for the net debt to EBITDA ratio. And as you see at the bottom left, the net value they could generate from that could be negative for lighting to up to $8 billion according to estimate for oil and gas. And as you see at the bottom, the multiple they could generate from that varies from 3.9 times to 6.8 times EV to free cash flow in general. On the right side, if they only divest a minority stake, so 49% of their sale, as you see again, it's about the same story, and the value you could generate from that, 0.4 times EV to net EV to free cash flow, and 4.3 times for the oil and gas segment. And important to note, on the right side, our EBITDA multiple that we're using are lower than on the other side because obviously there's no control premium on that. So these companies will pay a lower multiple specifically. And so, so we believe it's not likely in the short term to create value for shareholders.
Our third thesis has to do with a short-term catalyst coming from the SEC inquiry into their accounting. So in Q4 of 2017, GE disclosed that it was being investigated by the SEC for two things. One, their long-term service assets LTSA accounting practices and revenue recognition. And second, they took a massive $9.5 billion pre-tax charge and also set aside $15 billion increase in their insurance reserves. That's $3 billion in Q1 and $2 billion to hit every year until 2024, and that's a very material amount. Their healthcare division has a $4 billion EBITDA, so that's like half their healthcare division. So a little bit about LTSAs. LTSA, the segment books revenue based on long-term assets for things like servicing power plants or engines. The portfolio has kind of mysteriously risen by 18% in 2017 to about $30 billion, and it's responsible for about a quarter of GE's pre-tax income in 2016. Historically, analysts on the street have called this segment kind of a black box because the level of LTSA assets and even their revenue is mostly based on GE's internal estimates and assumptions. Connected to that, recently GE took that massive charge in their insurance division, and they said the charge was due to severe underestimation of their health policy payments due to incorrect actuarial assumptions using also their internal estimates. So if you connect the dots, this also calls into question about GE's accounting on LTSAs as well, and that's why SEC is looking into both of these. So this impacts GE's valuation, we think, in two ways. One, many analysts on the street still value GE's capital business, which insurance is a part of, at about using PB ratio. But we think the massive insurance charge could lead to further write-offs, and the actual value of GE Capital might not be $2 to $3 a share, but might even be much less, even closer to zero. And that's actually not baked into our base case. So that's like incremental. If GE is required by the SEC to write down their LTSA assets, remember this is like a quarter to a fifth of their net income, their EPS, this could drive further downside. So let's talk about valuation. So we think the most appropriate way to value GE, being a conglomerate with a lot of divisions, is the sum of the parts. I'm not going to go too much into it, but we basically, in the down and base case, used Dividend's our own EBITDA estimates. In the up case, we used the consensus. In terms of multiples, in the base case, it's mostly the comps averages. In the down case, we use the underperformer, and up case, top performer in the sector. So from that, you get net, if you add in net debt, underfunded pension liability, you apply a 10% conglomerate discount and a minority interest. It gets you, in a base case, to about an equity value of $102 billion, implying an $11.79 per share, so about $12, a 23% downside. So this is our comps table. Happy to go into it in the Q&A.
Thanks. So we took a bottom-up approach with our DCF models, and we use a WACC of 7.5% and a terminal growth rate of 2.8%, and come up with an enterprise value of $183 billion. And that gave us an implied price of 11.85. And we took an average of both methods to come up with a target price, which is the one circle in red, 11.28, representing a 22% downside. And so obviously, if the power of business grow fast, perform better than we expected, it's going to materially impact our valuation. But we assess the probability to be low because GE Power just laid off 12,000 people. And even though if the business pick up, it's hard for them to ramp up the business just like that. And we also assess the aviation to be medium, but because we have keep our valuation assumption to be close to the street estimate, so we're not having too much risk on that regard.
Thank you, Tim. So just to conclude, there's three elements that we highlighted today in our short thesis on GE. First element is that we believe the consensus estimate is too high for 2018, and we've shown you why. The second reason is we believe that the potential for asset sale is overestimated by the street, and people believe that it will generate value, probably wrong because the company trades today at a much higher EV to free cash flow multiple. And lastly, the SEC accounting risk is definitely something to monitor in the short term and definitely a negative catalyst that could happen in the story in the short term. And with that, we're ready for Q&A.
Maybe just to kick it off, could we talk about how you value GE Finance? And you made a comment that it could be worth zero. I think book value is around $20 billion. Maybe how you arrive at that draconian scenario?
I think a draconian scenario would be zero. It's probably somewhere in between. This is not baked into our valuation, so this is, well, like I said, GE Capital is kind of a black box. They've been hit with multiple accounting scandals in the past. In 2009, they had to settle a charge with SEC for their also revenue recognition issues. So if you can't get transparency and clarity into this business, how do you, really, like they just got hit with a $9 billion pre-tax charge, and then they have to put $3 billion every year into $3 to $2 billion every year into GE Capital. So that's, right now they're also, I think, negative. In negative operating income as well. So,
but it's not enough for you guys to tell us that could be between zero and book value. We need to know your assessment of what the capital side is worth, because it does weigh on the price target and the eventual realization of a profit on the short.
Right.
It could evaporate your entire expected downside, depending on how things move.
I think there's limited upside to GE Capital because we value it right here on 1 times book value. It's not going to go to like 2 times book value. So
they may sell off certain parts of the business at multiples of book.
But just to come back to the point we made from the industrial side, they have a significant pension liability on their balance sheet right now, and the company is highly levered. So how do you split the debt? How do you split that? These are elements that will also impact the value that we generate potentially from the sale of such asset. And so we believe that it's probably going to complicate the process as well, and probably impact the value you could generate higher than maybe what we expected.
Did you guys look at tax leakage on asset sales? Meaning GE's historically had a very low tax rate.
Yeah.
Very low, amongst the lowest around. And the thought is that when selling assets, it's going to impact that tax rate, and it's actually going to levitate back higher. Just curious if you modeled that out. What did you use as a tax rate when thinking about cash flows and the worth of the company on a DCF basis, or even just on the sum of parts, earning power?
So sum of parts, we didn't really look at tax because we just used comp multiples for DCF.
DCF, we didn't really consider that, but then
it was about 21%.
21%,
Yeah, it was about 21%. So we modeled what the company has been reporting recently. Mm-hmm. We didn't put any assumption sensitivity on that analysis, but the 21%. Like you said, it could go higher if they were able to sell division, maybe reduce international exposure, affect their profitability as well. So it's something that we
would bolster your case.
That could be pro and con depending on if their asset are selling international with lower tax rate, or because of new tax rate in the U.S. could also impact the business. But we didn't pay close attention to that.
That's another question, just a strategy question. When you think about GE, you sat back and looked at GE, the history of GE, and what went wrong and where the wheels came off here. How did they get to this position where the stock's been under so much pressure? They're thinking about bringing up the company. What are the lessons learned? What did they do wrong? What did they do right? Obviously, what they did wrong overwhelmed what they did right because it's under pressure and there's duress going on. But how do they pivot this thing, turn it around here? How does it break your thesis? In other words, what are you missing potentially that could go right here? Because there's so much negativity around the stock, on the street especially, and you obviously guys feel the same way. Just curious how you're thinking about that.
So I guess what's wrong with the companies is kind of what's covered in their restructuring plan. We saw the 3 big chunks of portfolio going wrong, which they want to correct, of capital allocation being horribly wrong, which again they want to correct, and again on the people strategy, GE has been a lot maligned for their compensation structures and lack of incentives versus performance within the company. So these are again the 3 chunks that, as we see it, and I'm sure GE is also seeing the same things, which is why they've put it in their restructuring package. Going forward, to your point on what could go wrong for our thesis, the only thing that we think can go wrong is whether this restructuring plan actually rolls out and there's steam and momentum in the next few quarters. And that, as we discussed in our second thesis point, is easier said than done. because of all the complexities regarding the pension liabilities and the huge debt overhang. Another point on this is that they want to get rid of things that probably nobody may want to buy, or in other words, they might get a much lower valuation than what GE would have preferred. So for us, there was very little room for optimism, at least for the next few quarters going ahead. Maybe 3 years hence, 4 years hence, we are talking about a new rejuvenated GE, but it remains to be seen how the path is going to be.
Yeah. And just to build up on what Devin is saying, just to give you an example, Bombardier has been through the same situation as a large industrial conglomerate. It takes quarters and quarters and quarters to build confidence on the street, because right now the credibility of the management is probably zero or close to zero. And so it takes quarter to show that they're going to be able to meet consensus and exceed their expectations to regain confidence. So we believe that it's not going to be a 6 months or a year story. They're going to believe to show sustained improvement in their business, their margin, and different quarters and different results, segment that they have in their business to be able to achieve that recovery.
Have you looked at, your sum of the parts analysis here? You're looking at these core business operations, and there's a catch-all for corporate. But did you try to locate and ascertain to what extent there were other assets on the books, other real estate assets, other equity investments that may be added to your figures that may affect your price target? That's not captured in these divisions.
Yes, so we did not specifically look at real estate the way you mentioned.
Or other assets, just anything beyond these core operations. There may be other assets on the balance sheet that are not reflected in this analysis.
So if it's fixed asset on that sense, yes, I think it could definitely create value and help the company, like you mentioned. However, will they be able to generate the value that's going to change? Recall that the companies right now are trading at 27 times EV to free cash flow on the industrial basis. And therefore, we believe that if you look at the valuation of the assets we look at on a net basis, was about 3 to 4 times EV to free cash flow they could generate from that, according to a scenario analysis. So even if they were able to sell these things, you have to make sure that it actually creates value for a shareholder and not destroying them by selling them below where the company is trading as of today.
I guess I would think about it as these assets are used to generate EBITDA. Or are you thinking about assets that are kind of just on the books, not generating any?
I'm just saying there may be other assets. They could be real estate. They could be equity positions. There could be working capital that are not tied directly to the operations you have there. And if you've not analyzed or taken those assets into account, they may affect your overall net asset value.
Right.
And may give you less confidence that there's significant downside potential from a kind of some of the parts.
I think what Lance is saying, he's trying to, did you mark to market the balance sheet for all the assets, for the option value and maybe current value?
No,
we did not.
We did not, no.
And one other question about that, the balance sheet. So you've got your oil and gas, which I believe is mostly tied up in Baker Hughes GE. That has a stock price. How does that market value of GE's position compare to your base case estimate for the sum of the parts?
It was largely in line with the estimates that we have. And we also looked at Baker Hughes and what the company Baker Hughes feels about their business. And again, the valuation that they could derive by sale of Baker Hughes or other assets within oil and gas would depend on how their performance is in terms of operations. And we don't have much confidence on that going forward.
But the mark-to-market value of GE stake in GE, Baker Hughes GE today is approximately $16.9 billion, or is it less, or is it more?
Well, for the scenario analysis for the assets,
I'm not talking about scenario. I'm just saying, what's the market value of GE's equity position in that listed company today? Is it more or less, or is it 16.9 billion?
I think it's about in line.
It's in line with our estimates for this.
Yeah, so they have a 62.5% stake in Baker Hughes as of today.
I think
I'm saying the market value. Is the market value today of their position more or less than the valuation that you have there in your sum of the parts?
So that we don't know. I think what we could have done is just substituted the EV/EBITDA method with the market value of the Baker Hughes.
I just don't know if that's significantly more or less than what you have there. Whether it assumes some appreciation to get to that number, or it's assuming some value destruction at the.
Right. I mean, I imagine it's probably not too far from this, but yeah, I think you're right. We should have probably substituted just the market value, like what's the public value of this Baker Hughes business, instead of using a multiplied by EBITDA. So I think that's fair.
If you were management, what would you have done? Would you have cut the dividend to zero? I mean, and why do you think they didn't? And what does that tell you about management's confidence in this restructuring? You're going to get paid 3.2% above market dividend yield to wait for these guys to see if they turn it around. What would you do differently, and what does that infer to you?
So on the dividend, the sense is that many in the street were expecting a cut, and they did come up with a cut. Probably people were expecting a more aggressive one. This does indicate that the management wants to move in the right direction, but maybe not at the pace at which the street wants it to move. Versus the question, why not a zero dividend? Possibly they want to keep some investors happy who want to have that box checked of having some dividend coming their way. But yeah, if I was there in GE, I would take a more drastic path towards going with the restructuring plan. Maybe.
And so the sense you might say that because they kept the dividend, probably they're confident in their outlook going forward. But if you look at the company's credibility over the last 12 months, how they missed consensus, missed expectation, missed their own numbers as well, I think their credibility is not really high right now on the street, let's face it. And we believe that maybe they're still over-optimistic about their outlook, and maybe they will have to cut their dividend again at some point in the future, depending on the outlook of the business and the performance they're able to generate going forward.
Why only use a 10% conglomerate discount here, given the value destruction that's occurred historically for this company? You've been sort of generous on only a 10% discount. This used to trade at a premium to some of parts, because the thought was that there was synergy value across the portfolio and they were a good asset allocator. I think we learned that they weren't, and they actually paid peak market, peak cycle, peak prices, and destroyed a lot of value. I'm just curious how you got to your 10% and what you comp that at. How do you think about just give me some sense around that number you got to. Because that's a big swing factor on what you're doing.
Yeah, I think when I was looking at some of the other conglomerates before, they were around 10 to 15%. I think I was looking at like maybe DuPont and some of the other ones, and they were also around like some other companies have massive conglomerate, like SoftBank has a massive conglomerate discount, but like the American industrial, like the DuPonts of the world have like a 10 to 15%, and to be conservative, I just used the 10%. It's not a super in-depth way I came up with that number.
Conservatism ruled here, is that what? Yeah.
But a risk to your thesis is also if management decides to unravel the entire business and sell off the pieces, divest various chunks of it, then you would assume that over time that discount would evaporate as well.
Mm-hmm. Yeah, but at what value would they sell these divisions? Will they take more time than what we expect? Is it going to be done next 12 months, or is it going to be longer than that because of this pension deficit and because of their debt level on the balance sheet? And profitability is different in each division.
Can I say just about the power business, because that's been a big swing factor and a big source of value destruction. It seems like they misread that market completely. They thought the market was heading a certain direction. They scaled up. They got expertise and went a certain way. And the market went the complete other way for them. So there's too much capacity. They've had to price discount. Any sense as to why they misread such a core market for them, and why weren't they nimble enough to adapt to the changing market conditions? Like, how do you handicap that and get a sense of why they made such a big missteps there?
I think they acquired Alstom to get sort of a geographic spread as well as a complete suite of operations. Alstom is more strong in the steam component, and GE was traditionally strong in the gas component of power, and that was kind of what they were thinking at that time. In fact, the street celebrated it when I was looking at 2015 newspaper articles, and they were saying, wow, what a great deal. And if you look at articles now, everybody's, of course, having a negative view on that. I think it is, one thing is the larger cyclical, not cyclical, but rather secular trend, which is movement away from coal and gas towards renewables. To give you an example, the Chinese are adding up 60,000 megawatts or so of solar power each year, and that's the kind of trend that you see across the world. So there's this a huge overcapacity, which I think GE and Siemens of the world, they've all missed the secular trend going forward.
It's that, but isn't it also because they were the large, massive scale turbines versus the smaller, more locally, smaller grid sort of. It's moved to a modular sort of market.
So they have both of these suites, and the flagship HA turbines, the newest ones, are the larger ones. So it does turn out that the industry right now has again moved towards the larger ones, because whoever's putting up a gas project wants to put up a 2 gigawatt, 3 gigawatt project, not a small project, because otherwise they're putting up 300 megawatt solar projects. Why go to the hassles of putting up a gas project when the prices are now almost even or even better for solar and wind? So I guess all of these guys, and certainly GE, missed the large trend. And as you pointed out, the strategy of having a small and big component and a steam and a gas component, it doesn't really work out, because whoever's putting in now projects are the large projects, so it didn't really work.
Can you walk me through this underfunded pension liability and how you're thinking about it, especially in the context of rising rates? Does that change the dynamics at all over the next few years?
So they mentioned that their discount rate is about 4.7% as of 2016. The 2017 number will come out in the coming 10K at the end of the month, so we don't know that yet. Obviously, this would be helpful for this specifically, but also the company has about $80 billion of cash on their balance sheet, so they could actually fund their pension liability if they wanted to, but they want to use their cash on the structure and the ratios and everything, so they're not ready to do that as of today. But obviously, this is something that could be positive, but at the same time, GE, the accounting structure of the company, it's not clear exactly how is it going to go. And I think the credibility that the street gave them, especially from accounting standards, a type of reporting, this could definitely influence the value, or if they were, for example, to increase the discount rate, maybe some people would be skeptical and be more on the negative side, because like all the history that Will talked about earlier of accounting practices that are probably not the most transparent, let's say.
If you look at your guidance on page 7, where you've got consensus to, like on power and in oil and gas in particular, you've got almost $1 billion reduction in your view regarding EBITDA for 2018.
Sure.
How much confidence do you have in that, and what kind of analysis did you perform to kind of come to that assessment? Was it just kind of, we think it's going to be lower and we're going to choose 3.4? And, like synergy realization may not be realized. That doesn't give me a whole lot of confidence that 1.7 is any more realistic than the 2 billion. And it could be 2.2 or 2.5. Oil prices have been up. I think there's risk on the upside, particularly on the oil and gas. I don't know as much about the power, but that would definitely have a big impact on some of the part total value and on the ability to realize this drop in the stock price.
Sure.
So the reason behind taking down the view on par, EBITDA of par was, one, the trend in the industry, and we were looking at reports from Siemens and ABB and what the competitors were saying. So everybody's thinking in terms of -20 to -25% revenue guidance for 2018 versus.
But doesn't that consensus number already take into account that? That's a street estimate, right? So they're already looking at the same information that you are, right?
Yes.
And that takes all that into account.
So this number actually takes into account almost flat revenues for GE, because they believe that because of the new HA class engines, they'll be able to steal share from Siemens and ABB. But as I pointed out, some things that have happened in the past few months, the failure in Pakistan and stories around that, they do not give us confidence that GE would be able to gain share, but we're rather pessimistic. We're not even assuming that GE will be in line with its peers like Siemens. We in fact think that they will lose share to these guys. So again, to give you an example, again going to this case of Pakistan, this was for one of their projects there, and when they started having concerns for the next project that they built, they gave the contract to Siemens. So we are adding a little bit of pessimism because of the failure of the HA class turbines. As I pointed out earlier, this may actually turn around. This problem may be solved by the end of this fiscal, but we do not see this getting solved immediately.
And I get that, but why did you choose 3.4? What analysis did you do to come to? Did you look at what was the fourth quarter, for example, the annualized run rate of EBITDA for power division?
We looked at organic growth rates for Siemens and GE historically, and GE has lagged behind Siemens. So we put that discount factor again. The street was equalizing GE and Siemens because they felt that this new engine would be able to grab share because of this new engine and be at par with Siemens. We are going back to the old trend where GE had a lower organic growth rate as compared to Siemens. And that was the reason for having a 20% discount below that.
30 seconds left.
I just have one quick question. Just on page 12, your sum of parts, I'm just wondering, are you being too pessimistic on this company? Are you guilty of maybe looking through the rearview mirror and maybe not the windshield? So you're valuing the company on 2018 numbers, and some could argue that they're under-earning their potential right now. Those aren't normalized EBITDA numbers, especially in the power division, unless it's structurally broken, maybe, or the others. So what are the chances this is sort of a pessimistic scenario, not a normalized scenario? Why didn't you use, for example, 2021 numbers, looking 3 years out, maybe on a normalized mid-cycle condition? Because that would probably give you a higher number.
The main reason why we use 2018 number is the fact that they miss so consistently over the past year or so, and that the confidence in this company right now is quite low. So looking at 2020 targets, 2022, and having something like that as target would be a shot in the dark. I mean, it's going to take time. Yes, we believe that this company at some point will recover from this draft right now, but with the performance and the quality of the management over the last year and forecasting their provision going forward, we're using their 2018 guidance as a set point and feel that it could even be lower than that. And I don't feel comfortable enough using 2019 or 2020, especially given this scenario and the fact that it's a large industrial conglomerate, has a lot of moving parts, and it's going to take a lot of time for this company to turn around. They will probably be able at some point, but it's going to take time.
But do you have a free call option on a turnaround at this price? Meaning, is so much pessimism baked in, and do you have a yield support underneath you that maybe people are looking past 18 to 20 and 21, I guess is what I want to know.
Well, if you look at where our numbers are, what we believe will happen in 2018 versus where consensus is, we don't believe it's time to step in, especially because the fact that we're lower than consensus, and we believe there's going to be further downward reduction and revision on their estimates, and therefore stock price will probably go lower again throughout 2018.
Before any sort of sense of recovery is what you're saying.
Yeah, exactly. Yeah. So we believe in a one-year window, we don't feel comfortable buying this name as of today. We want to see consistent improvement in results, and we don't see that today. They still miss estimates.
What about on a 3-year outlook? Does your view change?
I'm not sure about a 3-year outlook, but maybe a 5 or 10-year outlook. Sure. This is probably something.
We had a similar discussion internally, and we all agreed that probably over a 4 to 5 year horizon, maybe we could go long on GE. But over a 1 to 2 year horizon, it's a tough call. We would rather be on the short side.
I mean, even if you're being optimistic, you only get a 12% upside using consensus and the best comps in the sector. So it's not a huge upside, even if you're being very like blue sky scenario. So.
Thank you, guys.
Thank you.
Thank you.
Well, we appreciate you guys all spending the early part of your afternoon with us. We're not your average value investor, also going by the name of NaVi. And we're here to tell you a story about a company that once was at the foresight of everybody's thoughts, but unfortunately is now in everyone's thoughts for the wrong reasons, which is why we're presenting a sell recommendation for GE. GE, as of the day we put this pitch together, was trading at slightly above $15 per share. Our 12-month price target is $12.69, which would represent about a 17% decline in their current market price. The chart to the left shows the relative change of the S&P 500 compared to GE. As we heard in the keynote speaker, the S&P has been going up, so I'll let you guys figure out which chart in line represents GE. On the EBITDA and forward multiples table, we're demonstrating the enterprise value versus the EBITDA. And as you can see in 2017, the line disappears, and that's because they actually had negative cash flow. And just to provide a point-in-time perspective of GE, we provided the financial dashboard over here, which shows various market metrics, balance sheet metrics, as well as ranges of their price. And as you can tell, they're quite low relative to their 52-week high. And now with that, I'd like to pass it over to my partner, Jeff, to talk about the company.
Thank you. So as you guys all know, GE is a big conglomerate with lots of different business lines. And one of the questions is, do they receive any synergies from having all these together, or is it better for them to separate? If you look at our 7 that we listed here, transportation, which is not listed because it's relatively small, is decreasing and it's not doing well. Power, oil, gas, and then the lighting business lines are struggling right now. Aviation, healthcare, and renewable energies are seeing, if you look here, we're seeing increases in revenues, which is, on first glance, good. The problems are, though, their margins are decreasing. So their margins have decreased from roughly like 7% to 5%. It's a little over 20% decrease. And then as well, GE Capital, they've actively been decreasing their capital shares after the recession. We have four theses that we're going to present. One is going to be that their valuation does not justify the numerous risks. There's definitely risks with all of their businesses that they have going forward, and then there's also a risk that we want to point out is actually at the lunch, if you guys were there, talking about management's ability to execute on what their strategies are. We're going to have mixed results here with number 2, pressure can burst a pipe. They have some businesses that they might be able to turn around, but it is going to be a struggle, and it's not something that can happen overnight. It is going to take time. A value story under siege. Our parents, our grandparents knew GE as this great company. It had this great reputation, and that's something that we think some people might still have biases from, but we don't think that's the case any longer. And then lastly, the liquidation value hits a low. Their assets have been tumbling, and their liabilities have been going up, so that's decreased their liquidation value, so we're going to get into that.
So we will start with our thesis number 1. The current valuation does not justify the uncertainty. So some of the uncertainty that we see, to name a few, CEO Flannery was here for less than 1 year, and we saw there's a tail liability in both GE and GE Capital of $31 billion and $15 billion right there that is not reflected on the balance sheet. And we see an inconsistency between free cash flow and EBITDA. And currently, the CEO Flannery has not given any clear target in terms of capital deployment or even capital structure, nothing. And we continue to see GE has lowered their profit guidance, and currently, no tangible catalyst. So I did a simple analysis valuation right here. Basically, it's using a sum of the part EV multiple. So I took average of the 4 different segments right here of the competitors and get the average EV to EBITDA multiple. And then I will multiply that by the 2018 expected EBITDA of the GE. And then we can sum it up to reflect the enterprise value of the different segment. Sum it up and subtract the debt, add back the cash, and we have the equity value of $14.71. And so I did a scenario analysis of this trading multiple right here and trying to see what if the liability that was not reflected, a crack on the glass right now, like what if it continued to increase? And what if the EBITDA margin decreased? I just want to let you know the EBITDA margin for the past 3 years of GE is lower, is 13% or lower. So if we tune it down, we will see that they can go lower than $14 very easily. Next one, thesis number 2. Pressure can burst the pipe. Turnarounds just don't happen overnight. We look at we see there's like increase in aviation, increased importance in healthcare, and also increased importance in renewable energy. But this all sounds promising, but it was continuously being put down by the macro pressure on the other segments, including transportation, power, oil, lighting, and the GE Capital, which they still hold on to, which is comprised of 52% of their sales. So, and the second point is turnaround strategy. You need cash. Where does that cash come from? We continue to see like there's like cash flow from operation like every year, but it was being cut by the dividend that they have, the huge 3% dividend right there. So we just don't think their turnaround strategy will happen overnight.
Thank you. Going back to our point that we think GE is a value story under siege. So GE has a reputation that is quite deserved as being a value stock. It was for our parents, it was for our grandparents, it was for me actually a couple of years ago. But I think it's a trap, and part of that has to do with the complex conglomerate structure that they have and the opaque accounting that can lead to an open to interpretation financial position. And what we mean by that is the recent slap on the wrist by the SEC on GE's insurance and capital business, where the SEC actually questioned the number of reserves they have for their insurance business, and as such, required an additional capital infusion to address that. And then we have to ask ourselves, do the numbers or management lie? We keep hearing that management is pursuing turnarounds for each of their business segments. However, we consider weak cash flow to still be weak cash flow, so we question what we're hearing. And then lastly, when the foundation of your investment for many people has been a recurring dividend, and that remains unsteady since they've been cutting it over the last few years, and long-term growth is questionable, we have to ask ourselves, are we actually investing in value, or is this a gamble on the unknown? And we think it's the latter. And with respect to our fourth investment thesis, we're looking at the liquidation value hitting a new low. And the way we looked at this was looking at the current assets plus a portion of the fixed assets, less the liabilities. And as you can see, those numbers are declining on a liquidation per share value basis relative to where it had been the prior few years, and also represented in quite a complicated chart. So you see it's declining, and we're questionable of what the value may be if it goes down. Now I'd like to pass it back to Raymond.
Okay. So we did an intrinsic valuation. We did not just take the sum, like the aggregate at the top level, and do the intrinsic valuation. We did the more complicated way, sum of the part, intrinsic valuation. And you can find the growth and all the assumption later in the appendix. So what we see right here is we sum up the free cash flow from each segment, present value, and the present value of the terminal value. Added up becomes the terminal value, subtract the debt, minus the minority interest, add back the cash, come up with the equity, minus the employee option, all those. Then we come up with the price of $12.69. Then we ask ourselves, what if GE actually did what CEO Flannery has publicly stated? Are we going to divest oil and gas? We're going to divest transportation. We're going to divest lightning. We rely on the number that we have from JP Morgan and see, okay, how is it going to be if they divest the sale? And of course, if you have to sell it, it won't happen in a year. And that's why we gave a little bit of a haircut. And after that, we come up with the same analysis. The value is $15.30.
Now, we're just going to speak quickly here about the relative value of one conglomerate, GE, versus its peers of conglomerates. And GE, as you can see, has been performing quite poorly relative to its peers. I guess Siemens has done pretty poorly as well. But the other conglomerates seem to be doing pretty well. They may not be as large in scale as GE, but they have similar operations, and we thought it was appropriate to look at that. On a profitability basis, these companies are actually making money, which is probably a good thing for businesses, and GE is not doing so at the moment, or not doing so as well as their peers. Then lastly, we look at GE's ability to convert cash, since that is a key driver for their stability going forward. And it takes them a while to turn their liquid assets into cash, and we think that could be problematic going forward, which further justifies our opinion of GE. Now lastly, we'll talk about the risk, and that will be Kunjan.
So, the proposition we're making sale are based on our assumptions and the research and the data we found, but you also have to incorporate the risk. What if we are wrong, and by how much can we go wrong, and how can it turn around and go up? So there are a couple of risk items we want to outline that we should be looking forward, going forward. One is the sum of the parts. What if it's actually greater than the whole? This is a very rare occasion, but what if when they have announced what they are going to diversify in the current environment where companies are paying high multiples for acquisitions, if they are able to turn around and sell those bleeding businesses for a higher multiple, that could increase their valuation. So that could go against our recommendation. Second is, will we be surprised by the growth? We don't much believe in the other growth segments that they're projecting, but what if power, which has been on decline, suddenly takes off, and those segments which are not growing start growing? Then will things start happening the way GE wants? The third is, what if the management, now we have seen the past management for many years has not been able to execute the strategy. Even though there's a new management, they have announced the same strategy. You can give them a benefit of doubt that by miracle he's able to pull it off and change things around, which we don't believe, because being such a big giant, they cannot be that nimble. But if they are able to turn it around and make those commitments comes to fruition in a year, then the stock price could see an uptrend. And the fourth goes to a concept of behavioral finance. GE has been in news a lot, but all for bad reasons, which might be causing pressure on the stock, and maybe due to behavioral finance making it undervalued than what it really is. So if that is the case, and which our numbers show is not, but that can also turn it around with anything good or new news coming out, can boost the stock price. So we just wanted to point out the certain risk factors that we should be mindful of going forward in our recommendation. And with that, I'll open it up for questions.
I don't get a great sense of your conviction in your sell recommendation. I see a bunch of scenarios, but I don't really sense that you can really, that there's that conviction level. For example, let's look at the balance sheet. When you look at the sum of parts analysis, you've got 1269 target versus 15.3. I mean, one's kind of in line with the market value, and one's a relatively modest downside risk. And even in that, without divestiture, I question your oil and gas assumptions, where you have a negative value for oil and gas, when in fact, if you look at the Baker Hughes GE investment, it has significant value associated with it. So I don't know how if that's even factored into that valuation analysis, but if it isn't, if you add that back in, both of these price targets would be higher than they currently stand, and higher than the current stock price, or at least in line with the current stock price.
No, of course, and that was a challenge for us to come to grips with as well. And in my heart of heart, I thought GE is a great company, and I still may think that at times. But with respect to our conviction on the sell, it's just we don't view it as a high opportunity cost, and that we could deploy capital elsewhere more efficiently. And so part of it is just we don't see the benefit to investing in it for future growth. And with that, we kind of anchored our view on the stock going down and staying around a low level. With respect to the Baker Hughes, from what we've read, GE's contemplated what to do with their 62.5% stake. What we've seen is that they're not totally sold on keeping the business, and that they plan on getting out of it. From my own personal view, the oil and gas industry, at least oil, has stayed relatively low and hasn't had significant growth. It's been about $50 or less a barrel for the last couple of years. And with that, there's not as much upside for those industries to invest capital in building wells. And so we think that there may be a slowdown for that, and I think that's partially of what drove the value. However, we do think that there is a value.
But without divestiture, you're showing, if I'm not mistaken, $2.8 billion negative value.
I'm trying to see, you mentioned 2.8.
Right,
do you not have a negative
there.
value for Baker Hughes?
Well, I mean, how there's a market cap of the stock and that they own. I don't know what that value is, but
I do.
Just look at the stock price.
It's $30 billion right now.
Okay, $30 billion. So how do you go from $30 billion to a negative $2.8 billion?
Because we expect.
Well, you can just sell the shares. I mean, it's a publicly traded stock. Now, they're not going to sell every share that they own in the market tomorrow, but that's a real market value.
It's an interesting point, because they have a negative discounted free cash flow value of 1.6 billion is what I'm seeing that leads to that valuation, correct? So you have a negative assigned value. You don't think Baker Hughes is ever going to generate free cash? Is that what I'm seeing?
At this
It may not. They can just sell the shares then.
We are thinking they are. So let's say if they have huge capex, like huge reinvestment, and then the growth, we are giving them a growth that is higher than a 10-year treasury rate. We believe it's not going to be excessively high. It's not high growth. It's a commodity business right now, and they are still struggling. We put the long-term growth to be 5%. And after this, of course, the cost of capital for oil and gas is actually really high, given the...
Okay, hang on a second. So you understand there's a disconnect, right? The market is saying this thing is worth $30 billion. You're saying it has a negative value. There's a huge disconnect in your sum of parts. Your whole short thesis turns on that valuation of that one piece alone. So, that's a big difference. And you're taking a variant view from the market. You're saying it's got a negative value. The market's saying it's got a positive. Not that the market's always right. I'm just saying you need to reconcile those two things. I guess did you cross-check against the market cap and kind of delineate why you felt something should have a negative value in the market that's assigning a positive value, which is what Lance is pointing out? You see how you could be off by $5 in your sum of parts.
Yes.
And
That's something we'd have to review.
yeah, I think that was oversight on our end.
Maybe go back to slide 10 as well. Walk me through the GE capital, that's worth negative 45 billion.
Yes.
It seems like we could divest that for zero. Maybe we could
Yes, they
just
can
shut
actually
it down.
divest them. And the interesting thing is, they want to hold on to it as part of the cash usage. And I have no idea why CEO Flannery did not express his interest to divest GE Capital, but rather he chose to divest, get more focus on power, renewable energy, aviation, healthcare, and divest oil and gas, lighting, and
What's the
Don't you
book
guys know
value?
the answer to that? You guys should know the answer to that. Why would you not get rid of that?
And what is the current book value of that division currently?
for GE Capital.
There might be are there other ways to look at it?
And the
Did you
very
guys look at other
interesting thing
ways?
is right now SEC is going over expecting GE is having material misstatement. So they're investigating right now. Are they using aggressive accounting? Are there some of the liability that you have not accounted for?
So whatever that stated book value is on the balance sheet, whatever that number, let's say it's 10, let's say it's 20, like $100 billion, you're assuming that all that is worth zero, plus they have an additional $45 billion of liabilities
think
attached to that.
If I remember
that
correctly,
operation.
the book value for GE Capital is about 9. It's about, yeah, 9.
Why do a DCF on a financial business? Because you came up with a huge negative value there. Using if you have your DCF blinders on, you come up with a negative value based on whatever input you put in. But I guess I'm asking why, like from a common sense standpoint, you didn't a sanity check. Wait a minute, if you wound this thing down, it's going to be worth something. Probably tangible book value, I'm guessing. Did you look at it that way at all?
I think they're using GE Capital as a source of cash flow. So that's why I put that in part of the valuation analysis. To your point, I also agree, it is a financial arm. So you cannot do a DCF of the financial arm right here.
Right.
But if you treat it as a cash flow generation, just like working capital, then this is going to be a long-term usage.
But strategically, they need it, right?
Yes.
They need it because it finances their internal operations. That was the whole
Correct.
reason for GE Capital, was to finance the engine business, all the industrial things. I mean, they obviously drifted and went away into other things and got themselves in trouble during the crisis. But the core mission of GE Capital is to finance internal projects, correct? So that's the reason why they didn't get rid
financing
of
for customers.
and customer financing.
But you think every dollar they plow into that business is generating a negative NPV, at least in the past, and they may not be doing anything
We don't
going
look at it
forward.
standalone because, like you said, most of the reason for the financial arm is internal and financing their products. Like when they try to go and sell turbines, they're using the G capital to finance to their customers as well. So a lot of that is driven if there's a high growth in their other product lines or not. The performance of the financial arm is going hand to hand to that.
And
So
that's the tricky part about valuing a conglomerate is you have a aggregate amount. Like each of them generate high revenue, but then there is a corporate aggregate cost right there. And
You already have a corporate, $15.2 billion corporate
Drag.
discount associated with the overhead. I guess I'm questioning whether it makes sense, does it pass a smell test to assume that GE Capital is a negative value of $45 billion and energy, which they have an investment that's publicly traded that's worth $50 billion, according to Todd.
30.
$30 billion is a negative $2.8 billion value. I just don't know if that, if from your standpoint, if that passes the smell
I think
test.
for
Did you think
long-
about that when it kind of came? I was like, there's this value in the market, but we're valuing at this. Does that make sense? I mean, you can justify it, but please do.
Yeah, it was likely a lot of oversight on our end and didn't fully question the results of our analysis.
Because that's the key thing. You guys want us to sell a short stock company, and you want us to think we'll make money on that. But if you get it wrong, as in the case here, where we think it could actually be, those signs could flip, we should be long instead of short.
I think right now the reason, another conviction about short is the uncertainty. Just like a lot of value stock, we think about Mattel, we think about Gilead. Oh, there should be value in there. But when you think deeply, when you see a sign of the crack, you just tell yourself, no, it's not, it's just a crack. It will heal, it will return. But we saw there are numerous uncertainty already. It is a sign of the crack.
But I have a question, may I interject? So uncertainty creates mispricing opportunities. Markets hate uncertainty, right?
And they already
and they cause inefficiency, right? You probably would agree with that, I'm guessing, right? So why isn't that a good thing? Why isn't all this uncertainty? You'd think a lot of negativity is priced in at this price today, even assuming your numbers were right, and taking aside the GE Capital and the Baker Hughes, which I think we all agree maybe should not be negative. Your downside risk is pretty small, and it's not exactly a precise number. There's a confidence interval around that. It's not a precise exercise. How do you know you don't have option value to the upside based on too much negativity surrounding the stock, and maybe some things that you haven't imagined that could happen positively?
The thing is, because some of the value that, like tail liabilities of these two, I don't see that as value that is included in the price right now. And some of the...
So you don't think the market knows about those pension liabilities?
They know about it, but they have not priced it in exactly.
So when the stock went from 30 to 25, from 25 to 20 to 20 to 18, 18 to 15, you don't think they factored in that at all?
I love GE to Ben's point. We do believe GE, like one of the greatest company back in the days, like that just make American proud. But when they began to have all these uncertainty, and John Flannery is just saying the same thing as Jeff Immelt, and you're not confident about the management, and you're not confident about their accounting. You're not confident when you look at...
You're telling us everything we already know. That's already happened. So I guess...
And that's why I did the analysis right here to see that the market price in the information.
But I guess to Lance's point, at $30, I could see where I think a lot of what you said was correct. At $15, I'm wondering how much is already known, discounted, ad nauseum by everybody.
And we agree, that's why our price target is not that far down. But it's just, we also don't see any tangible catalyst for the upside unless that market realizes, oh, we discounted it too much for whatever reason.
Could there be catalysts out there that you just can't see?
Could be, if it's not.
Currently, no tangible catalyst is my point.
That we could not find.
You don't think EBITDA margins may be better than anticipated?
For the past 3 years, it's under 13%. And then even 4, 5 years, 6 years ago, the EBITDA margin is just 13 to 15.
But let me challenge that notion. So on a normalized basis compared to their peers, like if you get the right management team, the right structure in place, they're under-earning their potential. Would you all agree with that? These are depressed earnings levels. And then capitalism, generally allows for improvement over time based on incentives, the right incentives in place. So why wouldn't those margins drift higher over a 3 to 4 year period? What's to prevent that from happening, I guess?
Where can they be that nimble and can they achieve those very fast? And about the new management, we haven't seen much concrete data to say that he will be able to do, because he's having the same goals as the old one and they were not able to do it. I mean, when he got appointed, Warren Buffett dropped GE from its portfolio. To us, there was a sign like, Warren Buffett doesn't believe in you making those things happen.
But Warren Buffett's not always right, correct?
True.
I mean, he's not 100% right. He's right more than wrong, but he's not always right.
We're also talking about some of like the GE's biggest segment used to be, like still, power. Power's forward growth is not expected to be high. It's like either flat or going down. So we're looking at aerospace, today, U.S. defense has actually the Congress actually closed for a short amount of time. So how do you value all these volatility, like all these that will trigger the aviation and possibly the healthcare? How is that going to affect it, the growth in the upcoming 1 year? So I see there's a lot of uncertainty, and the most important, I think, is when the accounting is not trustworthy, and you see the cash flow has been continued to deplete, and they have no sign of further cut. In the past 125 years, there's only 3 cuts on a dividend. And let's say if they do a 4th cut, is that going to change some of the investor, the investor group will change from dividend investor to other type of investor, speculator, that will generate maybe even more volatility.
Can I ask you, what was your sum? You did sum of parts on a discounted free cash flow basis. Did you do sum of parts on a multiple basis? And a breakup value, meaning like if they broke up the company, sum of parts, what is that worth right now?
If they break it up, so that is similar to the EV. I'm using the multiple of the industry multiple of different segment, and then come up with the EV right here. So this is the price of EV of each part.
I question the conviction level that you must have on this analysis when you look at, for example, these comps in each of the 4 categories. Power, the multiples range from 7.6 times to 24 times, and aviation 7 to 22, and the same thing, 20. It's just a huge range. Why do you believe that 14.17 times is the absolute appropriate multiple for GE?
Law of large number.
Well, no, I mean, given the disparity, given the lack of, I don't think statistically you have much confidence in that multiple being, being as good as 15.2 or 11.2, given that you have just a small sample size and you have such a range.
That's true, and we wanted to be conservative instead of adding more bias. So we took with the average, which seems to be the general estimate. Usually you would either discount that average or add a premium based on GE's own position compared to the peers, and you're right. But we wanted to stay the same across the board, so we used average for all the ranges, for all the segments. But you're right, GE could be more comparable to the one at 24, but again.
If you took the median, you may have gotten a value that could have been $2 plus or minus what you came up with. And when you're asking us to invest our capital.
And then we have to value how's the liability. Right now, there's only $15 million for the insurance part. What about the underfunded status of the pension? And how is the operating margin, EBITDA margin, going to be? Those are really questionable.
Can I ask you on slide 9 on liquidation value? So it looks like you guys took current assets and then slide 9.
I think everything but goodwill.
Yeah, so if I look at the accounting right, we got book value of 85 billion, but we got 100 billion of goodwill. So we got negative tangible book value. So how confident are you in the liquidation value?
The liquidation value right here is trying to show that it is not higher than the current stock price. And there's a range that you can go further down. There's further weakness right there.
But this is based on historical book value, not current market value, correct?
No, it's just book value.
So is book value understated or overstated?
Understated.
It's understated.
The current book value that is is lower compared to the market cap. That's true.
So like Coca-Cola, the balance sheet doesn't reflect the brand equity and the values associated with the businesses. So why even prepare this analysis?
Because we're trying to show, let's say if they use all their current asset and subtract all their current debt, just liquidate the whole thing. how much cash do they still have?
Isn't that what the sum of the parts analysis does?
True, that's also the purpose of this is just trying to show it can go lower.
Okay.
You mentioned on your intrinsic value, you use a terminal value. How did you come up with the terminal value? Did you use a multiple? Did you use a
No.
formula? What did you use to come up with terminal? Because that's
Yes.
80% of the value. Tell me how you came up with your terminal value.
Yeah, so what I did is I go into each segment and then try to forecast what is the growth for each segment and come up with because due to limited information, we cannot really dive into the operating margin for each segment. So we have to use an average, like the current target operating margin of GE. And after that, we come up, of course, we also have the cost of capital using risk-free rate and the beta, industry beta, based on the current, corresponding industry to come up with the cost of capital. Then start with I should start over with the revenue, with the growth, then it comes to the revenue, and then with the operating margin, we have the EBIT, and minus the tax rate that we expect to gradually increase to the marginal tax rate of 21%. And we have the earning before tax, and minus the reinvestment that we believe to be. And
So it wasn't a terminal multiple, it was terminal formula is what you're telling me.
the terminal, yeah. Oh, we used dividend, not dividend, future free cash flow divided by R minus G.
We used the Gordon growth method.
Yep, I got it.
Slide 16, why is your levered beta for the financial arm 0.18?
Slide 6.
The very far right-hand side under assumptions on page 16.
Yes. Why
And you've got
is-
negative cash flows the whole time, so isn't that supersizing negative cash flow?
For the present value of the free cash flow?
Yeah, so what's driving that? So you got a levered beta of 0.18 for the financial arm.
Negative beta?
No, it's
yeah.
0.18. Yeah.
Yes,
And then the EBIT is negative every year.
Yes. So the beta is based on the industry average of, let's say, if it's a financial service company.
So the beta is 0.18 for financial.
0.1. Yeah, the unlevered beta is 0.1.
The unlevered is 0.1, the levered is 0.2, let's call it, right? What you're saying?
So financial companies, they don't have beta relative to the market?
True. Well, this is based on the industry average of the financial service. So true. I mean, it is there. The beta should be higher. I agree. Yes. Yep. Okay.
Thank you.
Good afternoon, ladies and gentlemen. We are AMP Capital. My name is James McNeil. These are my colleagues Ashley Allen and Blake Peterson. And we are here to recommend a long on GE with a price target of $80, which is an upside of 16%. Then that was using market prices from a couple of days ago. And obviously, we've had a few drops since then, so we're looking at an upside of 25% now. GE is a long-standing industrial conglomerate with 8 major segments, several of which are in very fast-growing and attractive areas, aviation and healthcare, for example. We have a strong brand franchise. GE's been around forever. However, in recent times, the market has looked at the fact that the power business has done poorly. We've had a dividend cut, an SEC investigation, and unexpected future liabilities with regard to the insurance. However, we think this company is now trading at peak pessimism. At 15 times next year's earnings, it's at a deep discount to its most relevant peers, Honeywell and United Technologies, that trade around 19, 20 times. Hence, we feel that the upside is more than worth the risk that we're willing to take. So now we'll hand it over to Ashley to speak about the company.
Perfect.
Sorry.
That's okay. All right, so how did we get here? I'm going to spend the next few minutes talking to you about the history of GE, roughly over the last 10 years. We're going to start with the financial crisis in 2008 or 2009. So GE Capital was at one point one of 8 segments and divisions within GE overall, but due to bad loans that they had on their books, they nearly crippled the entire company of GE as we know it due to their financial decisions. They required a bailout during that time. Since then, GE Capital, as I'm sure you're aware, has been spun off / restructured, but GE as the company has retained some of the liabilities that we learned of this legacy GE Capital. Since the crisis, the company has tried to refocus to get back to its roots of really being an industrial conglomerate. So it sold its stake in NBC. It also sold, or licensed off, I should say, its appliance division as well to a Chinese company. And that really left us with 7 core businesses. Within the 7, kind of the 3 crown jewels have been power, aviation, and healthcare, like we mentioned. Within the power division, GE supplies equipment that helps fuel about 1/3 of our global power consumption. Within healthcare, GE supplies some of the leading technologies in regards to medical imaging that we know of. So that's MRIs and X-ray machines. And then within aviation, they have a very, very strong franchise in regards to airplane engines that they supply. So those 3 kind of segments are what's propelling GE forward. Let's kind of speed up a bit, talk about what's happened recently over the past 6 months or so. Back in January of 2017, it came to light in the market that GE's acquisitions that they made of Alstom and Baker Hughes probably weren't as strong and synergistic as the market anticipated. That's when you see that the stock price of GE began to decline. So since this time last year, it's down about 50%. So that's weighing on the market. GE also has had CE turnover, new CEO this past summer. They announced that they're going to cut their dividend in half. So now it's 48 cents per share annually. And top it all off, they announced more liabilities in regards to their pension, which was about $6 billion that they wrote off on Q4 of 2017. As well as legacy liabilities from GE Capital that they will be responsible for going forward. That's about $15 billion they plan on funding between now and 2024. These 3 things combined, again, have really pushed the stock down. Like I mentioned, 50% roughly over the past year or so. Nobody likes GE as it is today. Nobody really knows what's going on within the division that it operates. But that's a great buying opportunity because, again, its core strengths are still there, being a great industrial conglomerate. This visually just recaps what I mentioned. The top chart, you can see that this is over the past 5 years, so not since the crisis, but they've had low ROIC, low EBIT margins, and last year the EBIT margin plummeted. This was due to their $6 billion pension liability that they wrote off. At the same time, their goodwill as a percentage of assets have been increasing. This shows that they've been serial acquirers of companies that haven't really added value too much to their bottom line. Just want to point out something down here as well. Back in January of 2017, you can just see the divergence between the stock price of GE as well as the S&P 500. This is when some of their, again, power issues began to come to light. With all the negative pessimism that's out there in the market, we are bullish on their new CEO and new management that they have. John Flannery is a veteran of the company. He successfully helped turn around GE Healthcare, and we're pretty optimistic that he's going to be able to do the same thing with the company as a whole of GE. He's made some comments recently that I want to point out. He stated last November that 2018 is a reset year for the company, and most recently, as about 2 weeks ago, he said, and I quote, "I'll do whatever it takes to really make sure that those businesses, which are power, aviation, and healthcare, are positioned to flourish in the future." Some of the other public comments that he has made is that he's considering all options for the company, whether it's selling off divisions that aren't as profitable or synergistic as they previously appeared to be, keeping the company together and just doing internal cost structuring, or splitting GE up completely. So all options are on the table. We think that that's bullish for share owners of the fund today.
Thanks. So I'm going to spend a few minutes addressing some of the issues on the short side of things. So we think GE right now, trading at about 14 to 15 times earnings, is really reflecting the peak pessimism, a peak amount of pessimism, more than it has since the financial crisis when it traded down to $7 a share. As we talked about a little bit, the business mix is now a lot different. There's a lot less focus on the financial businesses and more focus on the industrial businesses. So it's really trading at a very distressed price, especially when you take that into account as well. Some of the short arguments are further multiple compression. To mitigate that, we see GE really trading at a discount to the broader market substantially, and a discount to other industrial conglomerates, Honeywell, United Technologies. GE, besides all the issues it's been facing, really has a few key core businesses that are clearly worth quite a bit. And we think that there is a multiple that's right for that, and it's a little bit higher than what it is right now. The other short case we want to discuss is some investors think there's limited tax benefit for GE. GE's corporate tax rate over the last couple of years has fluctuated quite a bit on some of the divestitures and acquisitions. So a lot of people don't think their effective tax rate will drop with the recent tax change to 21%. However, the territorial system that has been implemented will allow GE to access overseas capital and use that to either reinvest in its business, buy back stock, pay dividends, things like that, that it didn't have access to otherwise or previously. The other thing we want to talk about is additional disclosure of finding out more bad things that could come out over the next year or so. We think that GE has spent the last year and really the last 2 or 3 months getting out all the bad news as possible to make sure you get it out all at once, kind of the kitchen sink theory. So we think that these issues have kind of led investors to expect that more could be coming. We don't think that's the case. We think we're at a point where there's been fear, uncertainty, and doubt, this huge price decline, huge underperformance relative to the S&P 500 that has created this moment of maximum pessimism that has given us this buying opportunity. A couple more technical trading issues that people think could impact the stock over the next 12 months. One is a possible removal from the Dow Jones Industrial Average. GE is the only original component still in the Dow Jones. It's been around for 130 years in the Dow Jones. Traditionally, the Dow Jones obviously is a price-weighted index. So the difference between the largest price and the smallest price, the Dow Jones has liked to keep that within 10 times multiple, 10x. Right now it's about 20x because Boeing's at $300 a share. To mitigate this, the management could consider doing a reverse split, 1 for 2, 1 for 3. That would get the share price up to $30 or $45 to take care of that issue. Other is if the dividend gets further cut or even eliminated, investors who are income sensitive or in those types of products that own GE for the dividend, there'd be more for selling. We think even with all the recent changes over the last year, the horrible results, the dividend is more than well covered by the cash flow of the business, so we're not too worried about that. The last one is if some investors might think that the business, GE might have to get rid of one of these core jewel businesses in order to raise capital or pay down some of its liabilities. We don't think a sale or a spinoff of one of these key businesses is likely for 2 reasons. One is there's a lot of value in having different business units sharing research and development, sharing intellectual property among each other, stuff that helps in developing better airplane engines is later helpful in the power business, developing turbines, that kind of thing. And then there's an issue with kind of allocating pension obligations across different business units. You can't really just leave them at the corporate level if you were to get rid of a business unit. So that would be another issue where we don't think a sale or spinoff of an individual business unit is the likely outcome. James is going to continue talking a little bit more about our valuation.
So on valuation, on the first page, we saw that the way we looked at it was applying an 18 times multiple to a $1 EPS. $1 EPS is in line with consensus, with particularly any variant perception there. However, we think the move from 15 to 18 is precipitated when they give their 2019 guidance, when they would have kitchen sinked all their earnings before this over the last 6 months or so. And the market will then appreciate what the underlying business will deliver going forward. As a backstop to this, we also performed sum of the parts analysis, adding multiples onto a normalized margin. So this is a sort of 10-year average margin and applying multiples from competitors in each segment. We then subtracted off estimated pension liabilities, roughly $30 billion, add another $15 billion for the healthcare insurance issues, and you can see that our implied value for share is $22, and that's admittedly on the more aggressive side. But more importantly, you can see that the aviation business is actually worth about 50% of the total enterprise value currently. And you see that healthcare is worth another $70 billion. Just those alone, which the sort of crown jewel assets, are worth so much that the issues in the other segments should be mitigated. Even the power segment, which normally trades at a margin of around 16%, dropped to 7% given the issues, but we've kept that going forward to keep the estimates conservative. And with that, we'll go to questions. Thank you.
Maybe you just want to talk about the dividend. I think it's on slide 7 when you mention the sustainability of the dividend. What gives you confidence that it is indeed sustainable, given it's not just the past management, it's the current management that's also had missteps and has had to cut the dividend?
Well, I think, the GE's paid a dividend for a number of decades, so there's a certain sanctity to the dividend, and they've cut it twice in the last 10 years, and that's really not a good thing. So there is some expectation to keep doing that going forward. For whatever reason, if GE could find a better use for that capital, even though there is this expectation, that could be one interesting area to explore. But we think, kind of given the priorities of the management team to reset and basically of the cash flow number of last year of $7 billion relative to the $4 billion in dividend obligations this year, at the current rate, we don't see why that wouldn't be something that they would continue doing unless they found a better use for that capital.
So you're that confident in their future cash flows. So we've just had a massive dividend cut, and then we've had to lower guidance again. So how confident can you be in their future estimates, given those pressures? And this is a highly levered company, right? We've got a lot of leverage. We're talking about selling off assets. This is not a squeaky clean balance sheet and a company that's operating very well. So how confident can you be that that dividend is going to be secured? Not that they'll have other growth opportunities, but they'll be under further pressure if these businesses continue to deteriorate.
Well, I think there will be some unknown unknowns, but we see the dividend as a clear priority for the company. It also instills discipline within the business, and we don't think that really the cash flow number is really at more of a trough place than a peak. So we see that there's a big cushion between 4 and 7, and we see it as something that's going to be there at least over the next year or two. So
we, with the asset sales as well, that gives them more leeway to potentially return to keep a buffer for excess cash to keep the dividend going forward as well.
If you go to the sum of the parts valuation on 12, now I know your charge was to make a case either a buy or sell decision on GE when you're out, but if you look at your oil and gas value for GE, $65 billion, which, if I'm not mistaken, their current stake in Baker Hughes is worth about $30 billion. So there's more than 100% upside potential in buying Baker Hughes GE based on your analysis. So why would you even say, you should tell us, don't bother buying GE, just buy Baker Hughes? Because based on our analysis and all the time and we put into it, this is where we should put our capital. Or did you even give it any thought that that value
I think there's
is
also
a total
other-
disconnect?
There's other
from-
power businesses within there as well.
No. I'm talking about oil and gas.
Oh, got it.
So more specifically, I mean, the profit is relative to the other divisions. I mean, it's much more cyclical, obviously. So you have to maybe potentially apply a discount to that. But still with
Well,
that.
but you're telling me that we need to, there's the stock of GE is worth $22, right? And in part because the oil and gas is worth $65 billion, right? So 65, but if the stake is worth, is it now?
30 billion.
$30 billion. I mean, why would you recommend us buy GE when we can more than double our money buying Baker Hughes, GE?
Well,
I mean, I guess I want to get, did you actually think about that when you did this? Like, the smell test did, what does this mean?
Some of this is, normal.
Just it's not all numbers.
Yeah. We think that there's some normalization here to get us to that value, and also.
So you don't really believe in the 65 billion?
No, we do. But this is a normalized version of what we think a business like that can earn. And,
Is that,
owning,
just so I'm clear, is that 9%, that 8.9% oil and gas normalized margin, that's a net margin?
That's earnings after, it's their segment profit margin, which sometimes includes tax.
Segment profit sometimes.
So when
is it EBIT or is it
it's EBT?
EBT, earnings before tax. Okay. So pre-tax earnings is what you're telling me this is.
Yeah. After interest.
Okay. Pre-tax earnings. So let's tax affect that. So you're telling me 9%. Let's just call it 6% normalized after tax. Maybe 7. Is that right? Okay.
So
You're about, because the street out to I'm looking at 2021 right now. It's got a 5% net margin on this thing. You have a margin. What? I guess
7.
Okay.
you're taking out the debt, right? So why wouldn't you do EBITDA up here? Because if you're doing earnings before taxes, then you're tax affecting it. So a healthcare company is worth probably 28 times PE on a normalized multiple. An aviation company is worth 25 times if I scale that up.
So you don't have as much information on the EBITDA numbers, if I remember correctly, from the reports as you do for segment profit and revenues.
Okay, so it's all you had was earnings before taxes. So if that's true, so if I had a healthcare, the normalized earnings before taxes is 22 times. Does that, I mean, the whole market's what, 16 times forward. Healthcare is at a discount on a PE basis. This is earnings before taxes. So you're saying that GE Healthcare is worth 50% premium to other healthcare companies? It's that great of a business?
I would argue yes. I mean, you can look at their revenue growth over the past few years. Now, granted, the issue that GE having, like GE Healthcare specifically, it's been clouded over these other bad divisions that just overpower it, and you don't see how good it is from a reporting standpoint. So it has had increasing revenues over the past 3 and 5 years. That's been both on volume and pricing that GE has said contributed to that. And we don't see any reason why that wouldn't continue going forward, at least over the next 12 months.
What are the top line numbers for GE Healthcare?
I don't have those off the top of my head.
Okay.
So just, I want to make sure we're doing apples to apples. So normalized margin, net margin after tax, right?
Sorry.
So normalized margin is
EBT.
EBT, earnings before tax. The multiple is also an EBT multiple is what you're claiming? Okay.
And do you have support for the multiples?
It's just comps and we backed out the numbers. I don't have it in the presentation, but.
And I'm wondering why didn't you use a conglomerate discount? Why didn't you penalize this company? Because they've destroyed shareholder value systematically for decades. Why wouldn't you discount the conglomerate structure for this? If this is a steady state sort of going concern, because that's what I think the multiples you're using and the margins you're using, why wouldn't you give them because the market discounts them.
Absolutely. So that's why this has a 41% upside for some of the parts valuation. Whereas when we looked at it on the other, at the start, we actually used the 18 times multiple because we wanted to make sure that we didn't over allocate money and take into account that conglomerate discount.
So the 18 times is used to base what?
So the 18 times used to base the EPS figure in 2018, but that which is using peers such as Honeywell and United.
So why give them the benefit of the doubt? Those firms that the comps you're using have out-executed them. They've run circles around GE. They have not destroyed capital like GE has. Why would you give GE a premium multiple to the market when they've destroyed capital and their peers have actually, built wealth over time? It doesn't make sense to me why you're giving the benefit of the doubt.
I think part of it is our optimism on the new management team, that it's willing to kind of do anything to get them from destroying capital to creating shareholder value. And that will play out either way over the next couple of years. But we feel positive about that. And the difference between the EPS valuation and some of the parts is really to show that, the sum of the parts is a lot higher. And even if you applied some conglomerate discount, you'd have to pick 10 or 20 or 30% or whatever, you'd still triangulate about to a similar price that's higher than $14 that it is right now, depending on how big of a discount you apply.
But I'm trying to think, on your upside, why would you give them an 18 multiple? The market's, let's say, 16.5 right now. You're giving them a benefit of the doubt for a company who's just...
So we give them a discount to Honeywell
but even relative
to concede though, it's a fraction of a discount, right? So like Honeywell and United, they're roughly trading 19 times. Like we're giving them 18 times. To push back a little bit, I think what you could be missing, kind of the market's historic love for GE. I think a lot of positive sentiment is built up for the stock to succeed going forward. I would argue nobody really wants GE to fail. Like it would be it'd be a very interesting story, but from a market sentiment point, they don't want GE to fail. I would argue they want them to be successful. We're bullish on management, and so we're giving them the benefit of the doubt of going forward, you should be able to be as successful as Honeywell with the capital that you have, with the businesses that you have. It's a mess right now. They absolutely need to clean it up and restructure, but that's kind of how we justify the 18.
The stock got cut from 30 to 15. Where is the bullish sentiment there? The brand value's been damaged. So whatever brand value halo effect they used to have, you could argue it's gone. It's just a show me story now.
Yeah, we think
by the end of this year.
That pessimism is really reflected in the price, down 50% when the market's up 100%.
But what the 18 multiple, what's the support for that? How is that?
That's what I'm getting at. Yeah.
Why is that so appropriate? Why isn't it 17.2 times or 16.7 times? Why is it 18?
Well, we think it's a little bit of, there is some of the assets we talked about, some of the great business units we think are better than market average businesses. And then we take into account some of the peers, even at 19 times, and there's no science behind it, but it's...
In a DCF analysis, you did perform, or?
We did not, given the
so nothing to kind
troubles that the company
to
are having.
To weigh whether 18 times makes sense versus some other higher or lower multiple.
Where's the justification for the better than market assets? Where does that show up? It doesn't show up in return on invested capital. It doesn't show up in return on equity. It doesn't show in return on assets. Why are these better than market? Everybody says this all the time. I don't see it in the numbers. So there's a narrative around GE, and they have high market shares, but it hasn't translated into returns. Do you see the disconnect between maybe the fact pattern and the name and the brand, maybe? Where does it justify that 18 multiple that Lance is talking about right now? We're trying to figure out the justification for that multiple, other than it's GE and everybody should own GE and GE has a right to be around. Maybe it doesn't. There's plenty of companies that have died. Look at the Nifty 50 going back to the 70s. How many of those companies don't exist anymore, would you say? Maybe 2/3? More? Why isn't GE one of those?
Well, we don't think it will be over the next 12 months. We get that it's kind of a battleground and there's all these narratives and different things, but we think given the level of pessimism we're seeing compared to historical pessimism, we think now is the time, if you had to go long or short, and you can't just say, put it in the too hard pile. We think it's a long.
But this is like an absolute valuation multiple that will help, you realize your price target. But, look at your comps in the Honeywells and UTX's their multiples have contracted of late, just in the last week or so, right? I don't know exactly how much, but it's a moving target. So I need more support from you to get a strong sense that 18 or whatever the multiple makes economic sense. And then I can hang my hat on that because that's what it's the whole basis for your investment thesis.
So I would agree with you, but then also to a certain extent, when faced with the choice, if you are too long or short a company, I think the risk in regards to shorting GE of where they are today, we do not think that they're going to go to zero. We do not think that the upside potential in shorting is worth taking on the risk of not longing it at this time. So we did consider that as well. You're absolutely right. There's no particular rhyme or reason outside of peer comparisons that we assign this 18 times multiple to it. But relative to the other choice that we had, we do think longing it is the better decision at this point in time.
Can we just talk on slide 6? So that gets exactly what you said. That's the crux of it. And maybe just elaborate on that a little bit more. What confidence do you have that this is not going to zero? This is a highly levered company. We've cut our dividend. We've turned over management. The stock just keeps going down. So what gives you real confidence that this is in fact not a zero? Because on slide 6, one of the concerning things that I saw on this slide is fear, uncertainty, and doubt plus a 50% price decline equals maximum pessimism. That sounds like a Bitcoin analysis. FUD, BTFD, right? But these things can go down 50% an infinite number of times on their way to zero. So what gives you the confidence that this is a going concern, we're going to get through this balance sheet issue and revert to what you say is a really good company?
So this is a little bit technical and just in trading a bit as well, but if you go back to the financial crisis, back of March of 2009, the lowest that GE traded around that time was around $7. And that was with GE Capital and all of its liabilities and et cetera, weighing it down. We're clearly not in a financial crisis, although you can argue GE's having a crisis of its own. So we considered the fact, potentially the furthest that GE could reasonably fall outside of going bankruptcy is maybe around that $7, $8 mark. A couple of other things give us long-term or at least confidence against the short as well. There's an activist investor that's involved. You can argue he helped push out the CEO, implement new management. We think that involvement is going to be bullish over the next 12 months as well. So those were kind of the main factors that we looked at when deciding not to short. We thought the downside / upside potential, the max that it could go down was around $7, $8, just from where it's traded at historically.
Do you think this is a very different company today than it was back in the crisis? Meaning GE Finance was the dominant, it was half the earnings, half of EBIT of this company. And I would argue some of the glow that GE had was from GE Capital, frankly. That was a high return business, highly levered returns. That made the industrial business look better than it actually was. So the conglomerate results were actually inflated by GE Capital, by them levering up that balance sheet, capturing spread in a big way, and going into areas unrelated to their core business. So how much did that color your analysis of what GE was and what could be, is what I'm wondering.
We think in any leverage situation, there's a lot of upside and a lot of downside. And in this scenario, we are less levered than we were 10 years ago and have a renewed focus on the industrial businesses. And ultimately, we're very certain that it's not a zero. There is obviously downside. But if in some scenario it were to be, the need were for it to break up or sell a division, I think there would be a lot of buyers for these assets. And that gives us some downside protection.
And to your point about the GE Capital performing well over that period of time, it also contributed to the risk, right? So as we've gone forward through time, we shrunk that area of the business. Yeah, sure, our returns don't look as good as they did back then, but our risks, I don't think, are as high.
Do you think the power business is an interesting business? There's a lot of swing factor there. If they could get out of it, do you think they would? Or do you think keeping it is the right decision?
I would probably say in the short term, keeping it is the right decision. When you just look at their historical results, 2017 looks a little bit like an anomaly, and that could be because of the Alstom acquisition and then Baker Hughes, et cetera. So I would like to see that play out for a few more years before they make a decision on what to do with that unit.
There's a right price for everything too, so.
A lot of companies before the crisis, to your point, levered up and inflated their financial results. So how are you certain, I mean, you made the point, right? It added to the risk, but in a bull market, GE Capital made everything look better. I mean, financial leverage works both ways, right? So how do you decide that didn't just lever up returns and make GE look like a great business, and then the financial crisis hits and all of a sudden it was just financial engineering?
So as you saw a lot of the sort of write-offs right for the few years after the crisis. But when we were looking back, we took a look at what was normal over the last sort of 5 years as well, so we could see if there was any specific disconnect between sort of the returns on capital between those 2 points, which you obviously did.
Let's say your multiples that you've selected are perfect relative to the comps, the Honeywells, the UTXs, the Boeings of the world. But if you look at the Boeings and the Honeywells and UTXs of the world, their multiples are at the high end of the historical trading range. You look at the performance of Boeing over the last year. It was, I think, the best performing stock in the Dow. So
It's only 100%.
yeah. So did you get? I mean, is there any concern that your comps are trading at a rich level, and that they may be, if anything, there may be some contraction in those multiples going forward?
Potentially.
You know, it's a rich environment as far as valuations are concerned.
Potentially, but then you're suggesting we have to stay out of the industrial sector entirely. I mean, when we talk about portfolio construction, then you could argue you can't necessarily do that.
The minority interest liability, what's that made up of? Page 2, in your capitalization.
Off the top of my head.
We don't know.
So where did that number come from?
Well, the financial accounts, but I can't remember.
It's from their financials, we're just not sure.
Do you know what businesses they don't own controlling? I mean, 100% of?
Baker Hughes is one of them. So 63% GE owned.
So presumably that's
Presumably
all Baker
consolidated,
Hughes.
but has to be backed out there.
Okay.
Yeah, because they consolidated, they have to back out the minority interest. So what's the bear case? What would make you short GE? Where could you be wrong in your thesis? What would break it?
Well, I think if the operating results of the business segments that we like so much show significant deterioration, then they're clearly not worth the multiple we have suggested. And we don't think that deterioration is happening in the aviation and healthcare businesses. So that gives us some confidence there.
But deterioration in those businesses would cause us to not want to long it.
Those are really
Is aviation sort of peak of cycle though? Aren't we sort of peak of cycle there in aviation, don't you think?
kind of debated. I mean, the aviation cycle has been growing 5% for decades probably in certain measures. So
there's cyclicality around that, right? I mean, there's
yeah, for some, the cyclicality is different for the different airlines is different than just manufacturing the engines, right? So we think that those businesses are really benefiting from strong secular tailwinds. So
right, I would agree with the secular, but I'm just wondering, from a cycle standpoint, are you walking in peak of cycle, peak margins, peak of cycle in one of their best businesses and assigning a peak valuation? Therefore, it's a mean reverting series, this business. Are you at risk of mean reversion to normalcy from peakish levels? Did you think through that?
I don't think we're at the peak yet. I think it's still ahead of us. So, I mean, global growth, global growth, especially this year looking forward, is pretty strong, and aviation is a big beneficiary of that. So, thank you.
Thank you.
Thanks.